Why are USD interest rates much lower compared to Kenya shilling rates or even other African currency rates, interest rates? They say high risk, high return, low risk, low return. The USD currency is considered to be the lowest risk currency in the world at present, or to be among the lowest risk currencies. Maybe Japan can have even much lower risk, you get. So, but the African currencies are considered to be high risk currencies. So if I'm an investor seated in New York with my dollars, and you want me to come invest in Kenya, I am moving from what is going to be a fairly safe investment environment to a very uncertain environment. Now, what incentive will the Kenya government give me for me to say it's now not worth for me to keep my dollars in the US, but to bring them in Kenya? So that's why there is what you call a premium is put on the USD return. So they say if the USD is at 2%, they say we have to compensate the investor with a premium so that we convince them to come and invest in our country. So that is why the USD interest rate is always much lower. If you look at the inflation in USD, it's far much less. You know, a 0.25 increase in USD interest rates is a headline news. 0.25. 5% inflation rate in US dollar, it is something that is huge news. But that's not the same for us here. And you can see, I'm mentioning countries that I'm familiar with. If you go to Ghana, your inflation rate is at least 19%. So let me talk about inflation. Inflation reflects how fast the value of money is depleting. Okay? I remember when we were growing up, I used to come from school on closing day, and I have saved the whole term 8 shillings, and I would pass by the butcher to buy half a kg of meat for 8 shillings, half a kg of meat for 8 shillings. We are now in 2024. A kg of meat is costing 1,000. Half a kg, 500 shillings, compared to 8 shillings when I used to buy half a kg of meat. So the 8 shillings when I was in primary school is now worth 500 shillings today. You get it? So if I kept my, or rather 500 shillings then has depleted so many times. You can't afford the things you are buying then, you know, it's much more expensive today. So then, because of the value, because of the erosion of value of money over time, the interest that we promise our investors must always be higher than the inflation rate. Let me allow that to sink in first. So if the inflation rate in Kenya is 8%, and you're investing in a product that is giving you 10%, it means your true return is 2%. That's why it's called a real return. If you invest in something that is giving you 6% in an environment where you are earning 6%, in an environment where inflation is 8%, it means over a long period of time, the value of your portfolio will have declined. So the inflation rate in US is so low, 0 point something, while the inflation rate in Kenya is in single digits, and while the inflation rate in Ghana is in double digits. So interest rates in Ghana are 20-something percent. Interest rates in Kenya are 18% or 15% or 16%. So you can see even between African currencies, we have an interest rate differential. Some countries are considered to be safer than others. So come back to your question. If you invest in US dollar, you'll get lower interest rate because your inflation is far much less. The value at the pace at which the value of your dollar is depreciating is so much lower compared to the shilling. And therefore, if you get 5% and the inflation is 0.2%, you have over 4% real return. If you're investing in Kenya shilling, let's say your inflation is at 8% and you're getting 10%, your real return is 2%. So 2% versus 4%, which one is better? That is just I have just demystified interest rate differential. And then that also is what affects the exchange rates. Yeah. So you'll notice when the inflation is high, you'll notice that even the exchange rate will tend to do bad.